I'm Dr. Jeff Camarda. It's October 21st, and I've got a special message about what's happening now in the markets. The below commentary is drawn almost exclusively from recent articles in the Wall Street Journal, most of which is quoted. So the market got a big jolt downward in early October, with tech stocks leading the plunge. That was the worst drop since the tariff tantrum in April, and maybe, according to some pundits, the one that could knock the wheels off the market, led by tech stocks under major pressure, according to the Wall Street Journal. Stocks are now more overpriced than even in the dot-com crash of 2000 to 2003, when they plummeted, you'll remember, nearly 80% and took 17 years to break even. Tech is now a far bigger piece of the market than 25 years ago, and if this bubble is finally bursting, led by the enthusiasm, the frothy enthusiasm over AI, there are concerns that investors might not recover in their lifetimes. So today's artificial intelligence-centered boom, or if you prefer bubble, has a lot in common with its predecessors, such as the LBO leveraged buyouts in the 1980s, dot-com stocks in the 1990s, and housing in the 2000s, which of course led to the Great Recession and the bear market of 2008. Stocks are at nosebleed valuations, easy credit for risky borrowers, faddish new financial products, and the list goes on. Gold, a hedge against bubbles, typically is looking pretty bubbly itself, and speculation has become woven into today's political, economic, and cultural psyche. Now, a bubble is hard to identify before it bursts, but bubble-like behavior certainly is not. Today's examples include tiny companies going public and then cratering, ordinary businesses turning into crypto Treasury companies by issuing equity and debt to buy crypto, and other examples. So are circular financing deals that obscure the underlying revenue or lack thereof. NVIDIA invests in OpenAI. OpenAI buys computing power from Oracle. Oracle buys chips from NVIDIA. You see how mystifying it can get. It's kind of like a shell game, right? So today, risk-on investors are flocking to all of these markets, stocks, betting, and crypto, and they're beneficiaries of a new age of democratic finance, or the last invitees to a party that's going to end perhaps badly. So Wall Street is starting to get a little bit defensive. In the midst of the market's most unsettling stretch since August, investors have turned real economy companies like utilities, healthcare stocks, and consumer staples, industries that reliably turn out profits no matter the economic conditions. Electricity, drugs, and groceries are always in demand, even when consumers buy fewer cars, phones, and streaming services. These three defensive sectors are on track to lead the S&P 500 index this month for the first time since June 2022, which is the last time we had a significant bear market. Still, real economy companies are playing a smaller role than ever in the 2025 AI-fueled bull market. Investors have also sheltered in bonds. The 10-year Treasury yield, which falls when bond prices rise, has dropped close to half a percentage point over the past 3 months to close below 4% since the first time in a year on Thursday. And that just means more demand for bonds. The demand goes up. Prices go up, the yields go down. And gold hit another series of new records this past week, though it is faltering as I read this today. We've been living in a disconnected environment for the past 6 months where the market just chugs higher and the news just gets worse. Below the surface, though, investors are pulling back from holdings more sensitive to a slowing economy. Regional bank, retailer, home builder, and airline stocks have all tumbled over the past month. These industries tend to flourish during periods of economic growth. Meanwhile, the surprise bankruptcies of auto parts supplier First Brands and auto lender Tricolor have raised concerns that the market's rally has masked pockets of weakness and potential fraud, particularly in the more opaque corners of the debt markets. When you see one cockroach, there are probably more, according to JP Morgan Chase Chief Executive Jamie Dimon. Now, of course, anything could happen. Anything can happen, and the trend is a trend till it's not, and the market can stay irrational longer than you can stay solvent, right? While anything could happen, Camarda clients and friends may want to consider if this may be a good time to revisit some of the portfolio protection strategies that Camarda uses and look at stress testing to see how far your neck may be sticking out. We're always happy to chat, so feel free to reach out to your personal wealth advisors. Non-clients can reply to this email or speak to their business development officer or fiduciary investment advisor. Thanks so much for watching. Once again, this is Dr. Jeff Camarda. Have a splendid rest of the month. Ciao.